Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Understanding Credit Default Swaps. Understanding the different types of credit default swaps can help you make smarter investment choices. Whether you're looking to hedge against the risk of a single borrower, diversify across multiple borrowers, or dive into segmented risk, there's a CDS type that fits your needs. Risks and benefits of credit default swaps. Credit default swaps, CDS, can be powerful tools in the financial world. However, like any financial instrument, they come with their own set of benefits and risks. Understanding these can help you make smarter decisions when dealing with CDS. Benefits: risk mitigation and portfolio diversification. Credit default swaps offer several significant benefits that attract investors and financial institutions alike. Risk mitigation. One of the primary advantages of CDS is risk mitigation. When you buy a CDS, you essentially transfer the risk of a debt issuer's default to the seller. This can protect your investments and provide peace of mind. Example: imagine you're a bank with a large loan portfolio. By using CDS, you can hedge against potential defaults, reducing your overall risk. Portfolio diversification. CDS can also help diversify your investment portfolio. By including CDS in your strategy, you can gain exposure to different credit risks without directly investing in the underlying bonds. Example: if you want to invest in corporate debt but are wary of holding too many bonds from a single company, you can use CDS to spread out your risk across multiple issuers. Potential for profit. CDS can be profitable, especially if you accurately predict credit events. If the debt issuer defaults and you hold a CDS, you can profit from the payout. Example: during the 2008 financial crisis, some investors made significant profits by buying CDS on mortgage-backed securities that eventually defaulted. These benefits make CDS attractive for those looking to manage risk, diversify investments, and potentially profit from market movements. Risks: counterparty risk, market risk, and legal risks. While CDS offers several advantages, they also come with inherent risks. Understanding these risks is crucial for making informed decisions. Counterparty risk. One of the most significant risks is counterparty risk. This occurs if the CDS seller cannot fulfill their obligation to pay in case of a default. Example: during the 2008 financial crisis, some CDS sellers like AIG faced financial difficulties, raising concerns about their ability to cover payouts. Market risk. CDS are influenced by market conditions. Factors such as interest rates, economic changes, and overall market sentiment can impact the value and performance of CDS. Example: if the market perceives a higher risk of default for a particular issuer, the premiums for CDS on that issuer will rise, affecting your costs and potential profits. Legal and regulatory risks. CDS are complex financial instruments subject to regulatory scrutiny and legal challenges. Changes in regulations can impact the market and your investments. Example: after the 2008 financial crisis, regulatory changes aimed at increasing transparency and reducing risk in the CDS market were implemented, affecting how CDS were traded. Complexity. CDS can be complex to understand and manage, especially for individual investors. Their structure, pricing, and market dynamics require in-depth knowledge and expertise. Example: misunderstanding the terms of a CDS contract or misjudging the credit risk of the underlying issuer can lead to significant financial losses. In summary, while credit default swaps offer valuable benefits like risk mitigation, portfolio diversification, and potential profits, they also come with risks, including counterparty risk, market risk, and legal complexities. Balancing these pros and cons is essential for effectively utilizing CDS in your investment strategy. Case studies: credit default swaps in action. To better understand the real-world impact of credit default swaps, CDS, let's delve into some notable case studies. These examples highlight both the successes and challenges associated with CDS. Success story: CDS during the 2008 financial crisis. The 2008 financial crisis provides a dramatic example of how CDS played a pivotal role. Here's a closer look. The Big Short, some investors famously depicted in Michael Lewis's book and the movie The Big Short, predicted the collapse of the housing market. They used CDS to bet against mortgage-backed securities, profit from default. As the housing market crumbled, mortgage-backed securities defaulted. The investors who bought CDS on these securities received large payouts, turning their foresight into substantial profits. Lessons learned. This case illustrates the potential for CDS to generate significant returns when used to correctly predict defaults. However, it also underscored the systemic risk and interconnectedness within the financial system. The 2008 crisis highlighted both the power and peril of CDS, showing how they can be lucrative tools for those who accurately forecast market downturns. Challenges: AIG and CDS failures. On the flip side, the story of AIG during the 2008 financial crisis showcases the potential dangers and pitfalls of CDS. Overexposure. AIG, a major insurer, sold a vast number of CDS contracts on mortgage-backed securities, underestimating the risk of widespread defaults. Liquidity crisis. When the housing market crashed, AIG faced enormous payouts it couldn't cover, leading to a liquidity crisis. The US government had to intervene with a bailout to prevent AIG's collapse from triggering further financial instability. Regulatory changes. The AIG debacle led to increased scrutiny and regulatory changes in the CDS market, aiming to improve transparency and reduce systemic risk. AIG's experience highlights the critical importance of assessing and managing the risks associated with selling CDS, especially when dealing with high-risk assets. Other notable examples illustrate the diverse applications and outcomes of CDS. Sovereign debt. During the European debt crisis, CDS on sovereign bonds became a focal point. Countries like Greece saw soaring CDS premiums as investors feared defaults, impacting their ability to borrow. Corporate defaults. In the corporate world, CDS have been used to hedge against defaults in various sectors. For example, during the energy sector downturn, CDS on distressed companies helped investors mitigate losses. Each of these cases demonstrates the versatility and complexity of CDS, highlighting their role in both hedging risk and speculating on defaults. In summary, these case studies offer valuable insights into how credit default swaps have been used in real-world scenarios. They showcase the potential benefits and significant risks, providing a balanced perspective on this powerful financial tool. Conclusion: the future of credit default swaps. Credit default swaps, CDS, have had a profound impact on the financial world, offering both significant benefits and substantial risks. As we look to the future, it's important to consider the evolving landscape of CDS and their potential role in modern finance. Key takeaways. Here are some key points to remember about credit default swaps. Risk management. CDS are essential tools for managing credit risk, allowing investors to hedge against defaults and protect their portfolios. Types of CDS. Different types of CDS, including single-name, index, and tranche CDS, cater to various risk management needs and strategies. Benefits and risks. While CDS offer benefits like risk mitigation and portfolio diversification, they also come with risks such as counterparty risk and market volatility. Case studies. Real-world examples such as the 2008 financial crisis and AIG's challenges highlight the powerful impact and potential dangers of CDS. Future trends. Looking ahead, several trends and developments could shape the future of credit default swaps. Regulatory changes. Ongoing regulatory changes aim to increase transparency and reduce systemic risk in the CDS market. These regulations could affect how CDS are traded and managed. Technological advancements. Advances in technology, such as blockchain and smart contracts, could streamline CDS transactions, making them more efficient and secure. Market evolution. The CDS market is likely to continue evolving, with new products and strategies emerging to address changing market conditions and investor needs. Sustainability focus. As environmental, social, and governance (ESG) considerations gain prominence, CDS linked to sustainable and responsible investments could become more prevalent. Final thoughts. Credit default swaps remain a powerful financial instrument, offering unique opportunities and challenges. By understanding their mechanics, benefits, risks, and real-world applications, you can make informed decisions and effectively navigate the complexities of the CDS market. As the financial landscape continues to evolve, staying informed about the latest trends and developments will be crucial for leveraging the full potential of credit default swaps. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.